Hey everybody, welcome back. Quiet day, but there were some ways to make some decent money here today, to say the least. I do want to talk about what we're seeing here because I think this is really pertinent. We had this really nice breakout on Tuesday on the CPI. We have given none of this back. Let's take this line off. I want to talk about Walmart's earnings. We need to talk about what's happening with AMAT after hours, why it's down over $10, and why retail stocks are just absolutely screaming except for Walmart. But see this level right here, 44? 73, 75, that is 50% of the bar. Now, I'm going to give everyone a really quick cheat code. Just pay attention to this. All you have to do here is pay attention to these levels and how they're marked off. And what you're going to see is, are buyers in control of this bar or sellers in control of this bar? Once it flips, you have a level. And it's very simple. Just utilize that and you'll make your life very simple. You can use that for your intraday trading. You can use that for your long-term positions. But we can't even get down this bar. Even if you put the most basic fib levels on, we're not going anywhere. Now, what happened today? Because I think this is extremely pertinent. What you're seeing is you're having these wicks right here. You have a doji right here. What did you do? All you did was fill in. We know wicks are what? Wicks are price rejection. So we rejected in here. The next day we filled in here. Let's take a look at this because yes, I do get this granular. We filled in here in the wick. Then what did we do? We came down, we rejected everything we recently filled, and we closed at a new high. It's really that simple. So we're not really breaking down. Now people would say, oh, well, the numbers today, and we're going to dig into some of these numbers in a second here. But the bottom line is this was fairly decent and very constructive action today. Now, something else that we must focus on is smart money, dumb money, and we're going to cover that. And I do want to point out a couple things before we go any further. People are waiting for this market to simply roll over. Now, we know that that's not going to happen. I know the moment you've all been waiting for the stool, but we know this is not going to happen. Why do we know that this is not going to happen? Because there's been a macro change to the market. Now, the same people that were saying technical analysis is clearly going to show that we're going to break down and this is clearly the high, they have no basis anymore to say that based upon the macro analysis and what's changed and the three things that have changed over the past 2 weeks. We went over it 2 weeks ago. I'm not going to bore everybody again with it, but there are three major macro events that changed. It's why yesterday when we showed what was happening in the bond market and the amount of inflows going into high yield and emerging market debt, this is changing. Fundamentals are going to change because of the macro change. Macro is going to make fundamentals easier for them to make earnings as long as the Fed didn't kill the economy, which we're going to find out in a couple months. Technical analysis is going to follow these three, and technical analysis can show us what's happening fundamentally, and it will also show us the macro shifts. But macro right now is ruling the roost, and we need to take that into account. Now, people will say, how can you be so sure of this? This is the 10-year. We have an island reversal. People will say, well, you really shouldn't short, or you really shouldn't look at the yield this way. You really shouldn't look at it and chart it. If it plots and has a price, I can chart it. You can chart anything. And you can see this pattern right here. This is a negative 3-bar pattern. We're breaking down. We put the most basic of indicators in here. We have a 12-22 cross. We have a 55-12 cross to the downside. I use a 12, a 22, and a 55. You should use what you're comfortable with. You can see how you're starting to roll here, and we're getting this declining pressure, these gaps, this ability for people, this pressure for people to buy bonds. We went over this a little bit in yesterday's video, didn't we? Where we have $5.7 trillion that's sitting in money market accounts that's going to start realizing by next month's statement that they're no longer getting the rate that they thought they were going to get. That's going to create a little bit of pressure on the market, and we can see that. And there's no more obvious way to see that than here. Now, this is something that if you're in the community, you're fully aware of because we purchased this down here around 84, 85 bucks, 85, I think. We're up about $5 in it right now and never even gave it a second thought. And the reason that we're looking at it is because we think the 20 years bottom. So we're looking at this for a long-term trade. Someone's going to have to explain to me in the comments how they're going to wind up raising rates again and that these are going to get cheaper because I don't see it. I don't see any fundamental reason to think that. I don't see any fundamental reason based upon inflows and macro analysis how high yield bonds are going to miraculously take out these lows right now. I don't see any reason to see that unless you're going to think along the premise of, okay, well, the economy is going to get so bad, the default rate's going to go up. And if the default rate goes up, no one's going to want high yield. That's one premise. How does that affect the 20-year? That's why you buy both, right? Because all they would do is go to flight to capital. They go flight to safety. That's why you don't buy one, you buy both of them, right? Okay, I hope that makes sense. I can cover that more on Saturday if you want to. But all right, so we can see where we're at. We see what's going on with high yield. How's the dollar holding up? The dollar's imploding, forming a bear flag, and we can see the level right here, and we can see the same cross. Very conveniently, that matches what? Matches exactly what the 10-year's doing. Isn't that a coincidence? So here we have the 12, we have the 22, and the 55. That's what I should use. You should use what you're comfortable with. And you can see how you're starting to break down here on the RSI. So now we have a lay of the land. What we should really focus on are just the basics. So let's clean off all my nonsense for a second. Look at the basic chart. And what is this basic chart telling us? Well, we have a doji. And like always, people will just say, well, since that doji's there, well, that means clearly we're going to stop. And you could see all the people pontificating yesterday. And here's where we are. We're trying to break out. What did we do? We stopped. Where did we close yesterday? Yesterday, we closed at 15,889.25. Today, you closed at 15,897.50. Okay? So take a look at where you were at on the close, 89.97. 89.97. You can see them switching up here. Okay. So we have a better close than we did the day before. Something to think about, because no one's really paying that much attention to it. So then you go here and you go, well, what was the close here? Okay, this was 59. All right, so 959, 889, 897. There's one close on the year that's higher. We have one close right here on the year that's higher than where we're at right now. Right? Just something for you to think about and understand where we are going into mid-November, where everybody is going to continue to do window dressing and Tuesdays in NVIDIA's earnings. Now, that's going to be a wild card, obviously, but take a look at the action today. This is all you're doing. You're breaking out and then you're going sideways. Why are we going sideways? All you're doing is working off overbought conditions, going to neutral, and then pushing higher. Working off overbought conditions, going neutral, and then going higher. Get it? That's all you're doing here. Working off overbought conditions, neutral, going higher. Over and over again. That's all you've been doing repeatedly. Here's a better example of it. If you take a look on a 4-hour chart, overbought in November, works off the overbought, goes back to neutral, overbought again. What's going to happen? Maybe we're going to go to here. Maybe we're not. Now you have a slow week next week, and we'll get into that on Saturday's video. But when we start to look at this, it's really hard to see how we're just going to say that we're just going to pull back. Where I think people are getting lost is not understanding how to trade this market. For example, Walmart was a great example. Now this is extremely rare, to say the least, for Walmart to miss after Target did what it did. So Target had a great quarter, but Walmart missed. I mean, it's got to be a decade since we've seen something like this. And after hours, we're actually seeing gap up. That's kind of a pun there, but gap's up $2 after hours. Ross Stores up $7 after hours. So these names are moving after hours, but some way Walmart is not doing well. So it's almost to me as if they're throwing the kitchen sink at the quarter. For whatever reason, maybe they're going to set low expectations to move forward. Walmart's done that in the past. They did it here. They talked about how bad things were going to be. I don't know if anyone remembers this. Everything was really, really, really bad. And then it wasn't so bad. And it was never that bad again. And then they just kept beating over and over again. So maybe this is a pattern that they do, where they come out and say things are really bad. And then for the next 2 years, they set expectations. And then they just consistently beat those expectations. Seems like an interesting game to play, something to think about. So everyone else is beating, but for some reason, one of the largest retailers in the country that is one of the lowest cost providers is not beating. It's very difficult to believe that they're not sandbagging, to say the least. So, all right, so we have this information. We see Walmart and Walmart's weak today. Do what you want with the statement I just made. What it did was it provided an excellent opportunity for those that understood how the market works. So what you'll see happen on days like this is they will take everything down pre-market, usually pre-market, and they will do what we refer to as shake the tree. And what they do is they want to shake the tree and they want to see who's out there and who they can steal from. There's no other way to say it. What they're trying to do is figure out who's got weak hands and who doesn't. Here's where you closed, and here's where we opened. Now, there was such a move. If you know how to read level 2, and you know how to read the tape, this was so obvious that there was a trade here, that this was going to head back up. Now, we didn't know that it would gap fill immediately, but that was the target. And it was a trade that took place. Literally, we knocked it out within 3 minutes, and we're able to capitalize on this and make well over $2. Here, watch this trade.
Target's most interesting to me, really, because people wanted to be at it yesterday. Now today they don't. Kind of has my attention more than any of them. But let's see how this goes here. Yep, you're already getting buyers there. You get people lined up in there. They're already jammed at the front desk. People trying to get in. Absolutely crazy. Let's see how this plays out and go from there. At least they're giving you this doji, so that'll make life a little easy for us to figure out. Looks like they're already having issues here, trying to get orders filled off the open. Already gapping up on it. Look at this. I'm gonna buy a target here, guys, to see how this holds up. I think this is going to gap fill, so I'm just going to stay with it. So I bought Target. It's the only thing I've done. I'm up about 20 cents in it. Oh, that was fast. I'm up $1 in it now. I think it's going to gap fill right on me. I haven't sold any of it yet. See what it does. $1.50, I'm up. $1.60, $1.70. Pulled something out. I mean, that was such an easy trade. There you go, 30. So, all right. So I'm up $2 on that. Out, kick some, up $2. All right. So I'm out of that trade. Completely out of the trade. I don't have any real edge in it anymore. $2, and I closed it. I was just looking for that gap close. So I just took it right off the open. Bought here, got off this little move, saw that it was jammed, meaning they couldn't get in. And then as soon as it popped up in here, I scaled out into this, and then scaled out to this. I'm completely 100% out of the trade. Thank you very much. Just locked it in. I'll just figure out what the next move is on the day and go from there. So, but again, I'm 100% out of that trade. Easy money. On to the next one.
Now, I hope you found that helpful, and I appreciate all the comments about seeing live trades, and I'm going to start showing more of them. Someone had a great idea to clip them all out and put them in separate videos, smaller videos, and then just have a play tape of it. Somebody in the community mentioned that. So we did pretty well with that today in the community. We did really well with a Microsoft trade. I'm going to walk through the Microsoft trade on Saturday because it's a little more complex. And what we did there was not have the trade, but then we were able to take the profit of the trade and then roll that profit into options that we were up about. I think we were up about 50% on, probably well over that at some point in the day. Hold on one second. I think they're actually up a little bit more right now, but here you can see we paid $375 for the calls. And literally that was paid with the profit from the stock. But I want to walk through how to do that on Saturday because it's a little more complex, and I want to save the time here for some other things that we need to address. So, but here you can just see, I like showing the timestamps on what I do when I do it so that you can actually see it and see when it plays out. Let's clean all that off now. If you are on the wait list for the community, look for a letter that'll go out tonight. I think there's 2 or 3 days left, and then the community is going to close for the rest of the week. If you're not on the wait list, there will be a link in description. So we're hitting all-time highs on Microsoft. Netflix is grinding higher. This is setting up for a massive, massive move. AMD is grinding higher and still fighting that 120. All we're seeing are these names continually grind and grind and grind higher. All right, so what I'm trying to get people to understand about this is the following. As we continue to grind higher, we're going to have people that are going to say it's too high. And I really want people to get this point. You have to wrap your head around the fact that you're not in the same macro environment that you were in previously. And that the reason that the market was dropping is what we went over on Saturday. What we went over on Saturday was very specific. And if you remember, we talked about the risk-free rate. We went over 3 core concepts. We went over the risk-free rate, right? That was really very important concept. Excuse me. It was a really important concept one of those days. It's been a long trading day. And so the next part that you want to go over is how does that tie into S&P earnings yield? Right? So when you understand that relationship, you know why the market is pushing. You know why the market's going to go higher. All right, that's really the main driver in what you're seeing here. And we expect that to continue, especially if rates are going to come down. Now, let's just talk about the basics. 15-year mortgage rate is already starting to drop. You already lost 5 basis points here. 30 years already dropping as well. Housing market data comes out. It's extremely weak. Another reason they're not going to raise earnings. Why don't I care about this? And why do I care about the mortgage rate? This data is behind us. It's not in front of us. Manufacturing production month over month. This you do need to pay attention to. You need to pay attention to this because what this is telling you is that things are weaker on the production side than they thought. Industrial production, you're seeing that significantly lower than it was before, way lower here than what we were expecting on the consensus basis. So we have to pay attention to that. Jobless claims is a non-event. This is the previous. When we start getting over 250, 300, I'll start looking at it. I'll start becoming concerned. But when you start to look at this data and you start to look at PPI negative, you start to look at retail sales negative, and they're adjusting these numbers. Core PPI 0. Core PPI year over year is down. So when you start really getting into these 1.3 versus 2.2, looking for 1.9, it's not realistic. Retail sales year over year at 2.5% versus 4.1. It's not realistic that they're going to raise rates again. Where we start getting concerned is the economy going to be worse than we think sooner? Now, we're going to address that on Saturday in some detail, so you're going to want to watch Saturday's video. And I do appreciate everybody sharing these videos. I just got another email from somebody that said they were referred to it. Actually, somebody, completely outside social media, which is kind of interesting. But we don't refer to this as smart. We don't refer to this as dumb. We refer to this as institution, and we refer to this as retail. And we can see right here that retail is red, smart is blue. And we just want to understand the basic consensus that when we're in a position here where smart money or institutions are really completely out of stock is usually a peak. Okay? That's usually where you're seeing some kind of peak where they are out of stock. When retail is fully invested, that is usually when you see some peak as well. And you can see this here. It's not always that way, but there's certain sectors or certain times when that'll work better than others. When you're putting $1.7 trillion in the market, it doesn't really matter. You can sell JPEGs and call them NFTs and charge $1 million for them. But this is where we're at, and we're back in reality. Now, if we look at just the basics and take a look at this scenario that happened about a year ago, 23, but within 1 year. So if you take a look at this where you have no real outside influence and you see how high we were here and you see how low we are here, we're nowhere near anything like that over here. A matter of fact, we're still net on both these levels. Why am I showing you this? I'm showing you this because there's a lot of room here. And by a lot of room, what I mean is here we are at the lower end, here you are at the higher end, and you can see these, right? You can actually see how these peaks are actually changing. Right? How when you're at the lower end, that's what? When they're selling their stock, institutions, and that's where you're peaking, and that's where retail is filled. But again, this is smart money by itself. And we look at these levels and we look at where we are. Well, you're net. You're net, meaning you're at 0.5. You're right smack in the middle of this roughly, okay? And so what is this telling us? Well, you would still have to drop in order for this to consider to be even remotely close to being in a position where you could utilize this and say, hey, we're in a position here where we look toppy. And you can see these right here. And there are spots where, yeah, you looked a little toppy. You can see it right here. And you look here, you can say it. Even here is the little one, and you can say it, right? Okay. Now, if we take a look at dumb money confidence, or as we refer to it, retail, and we can see that these lows, and where are the lows usually at? Well, we're not usually fully invested at those lows on dumb money, are we? So then you have here, and you can see what's happening. Well, we have to get all the way up here, don't we, in order for us to peak? All the way up here for us to even come close to having a peak. And this is absolutely, to me, glaring. So again, it was even glaring here when the Fed stopped intervening. Once the Fed stops intervening, you can actually see the market do what it's supposed to do. And when we're completely maxed out on the retail side, and you see that you're completely maxed out on the retail side, which would put you, let's just say it puts you here, and you look at that, you're here right now. You're nowhere near maxed out. And so you need to take this into account that, well, how much money's out there that could come into the market on the retail side and how much money could still come out of institutions. The answer is a lot. There's a lot of money. So that's why you're starting to see these names like Apple, Amazon, even when they're dropping, they're not dropping anymore. And what you're starting to do is you're really starting to frustrate a lot of short sellers because they're not understanding it. You understand it because you understand and have a basics of macroeconomics at this point. Hopefully from watching this, you at least understand the basics, right? If you understand the basics, you can at least be deadly. You know that when bonds are bought, dollar's going to drop, equities are going to go higher. I mean, you know that now, right? We know that when bonds are bought, the dollar's going to drop and equities are going to go higher. If we know that, then we know more than the majority of retail traders that are out there trading. When you start overlaying that with earnings and sector rotation, it makes you deadly. So if you looked at sector rotation today, you should have noticed a couple things. And I can't stress this enough that you want to start looking at sector rotation. You want to start paying attention, saying, hey, what's dropping? Well, oil's dropping. We thought we were going to bounce off this level, and we didn't. We talked about this, right? Are we going to bounce off this level? Are we going to hold in here? We talked about this with energy. What happened with energy today? Energy cracked. Well, that is a really long trend line, and you cracked it. You pretty unequivocally, you've cracked that level. So these are things that when we start looking at and going, well, where's the money going? And we start looking at which sectors are up. Well, Utes were up today. That usually bodes very well long-term for the market when you're seeing Utes. We talked about this with Southern Company. This is one that we did in the community. Got it in about down here. We're up about $5-6 in it at this point. Then you start looking at what was your second one that is breaking out. Okay, so the second performing one today was XLK, and you can see that very clearly. XLC was third. Look at that breakout. So here we are with tech breaking out to highs, and not just any highs, all-time highs. So we are breaking out of all-time highs. 3 weeks, and we were waiting for the end of the world here. It all changed, and you have to understand that it changed. So as I like to say, adapt or die. And this is what's happening right now. So the question is, what will be next? The answer is, we're not sure, but we do know a couple things. We know that XBI is going to have a lot of weakness going into December because of tax selling. I have a hard time believing there's not some gems in here. There's a lot of these names that are actually trading under cash value, and I think we should pay attention to them. If you look at XLY versus XLP, and what this shows us is wants versus needs, right? You just divide these two by each other, and it really is just wants versus needs. Go take a look at this on a weekly chart, and let's just zoom out in a second and drop this down, because I think this is really fascinating. So if you were in an environment where you thought you were going to be worried about things coming in, or people were worried about a recession, you would start seeing people buy their needs and not their wants. And that's not what's happening here. Matter of fact, what's happening is you've continually tested this neckline right here that goes back to 18, and all you're doing here is you're starting to see retail get bought. So one of the theories that I've had that I think I'm not going to be 100% right about was XLY, and I thought that I might see a lot of XLY selling in here. Based upon the macro analysis and the things that have happened, I have to reassess that thesis. Hopefully you can see how that works and how the stool plays into that. For example, a lot of people are looking at ELF. Now, I've been saying ELF is toast. I could be really way off on something like that now, because we've had this breakdown on earnings. To me, the earnings quarter was good and nobody cared. So the sentiment has shifted. If we get rid of all of that and you look at this chart, it's really hard to not start paying attention to what's happening here. And I'm sure everybody sees this, but let me just draw it in so you can see it yourself. And you can see how you have that level here, and you can see how you're starting to widening out up here. These are not the names that you want to second guess on when you start seeing this kind of widening. So I'm waiting for some kind of tax selling, because I was looking at this level. So what I do going into the end of the year is I will take a look at where they are anchored VWAP from the beginning of the year, especially in the last 4 weeks, and then you get a sense of how they're going, right? And look at what we've done the past 3 days. So my thesis on what's supposed to happen here could be way off. And then that's going to dive me into more wants. How's Alta doing? Well, we held our level in here, but we're still way over. So maybe that's not the one that we would look at. And you would just start diving into them and drilling into them a little bit and seeing which ones look like they're going to go and which ones don't. One sector that looks just amazing is semiconductors. And this is exactly what you want to see. Now, you have AMAT down after hours, and there's a litany of reasons for that. There's some kind of investigation into them skirting China's issues. That's going to be AMAT's issue. It's not going to be a SOX issue. But if that knocks something like the SOXL down tonight, well, that might be something that you want to consider and take a look at SOXL tomorrow if it does something like that, right? Because that's one stock and it's one company that's having one issue. And if that's going to put pressure on them and you know what's driving it, then that gives you an edge. Meanwhile, you're watching NVIDIA trade up after hours. So I'm going to dive into the wants versus needs names a little bit more and take a look at what's going on there. What we did see was a lot of weakness. I'll drill into this here this way. We'll blow this up. But there are a lot of people that were shorting this today in the community. I didn't really do it. I was more interested in my longs. But it was really clear. You got right to your neckline. Once again, we can get rid of the pre and the post. And you just see what's happening. I mean, this is technical analysis 101. Support right here becomes what? Resistance. And then all you had to do if you wanted to do this trade, and this is what people did in the room, was, okay, wicks are what? Price rejection. Two price rejections right against what? Support. Well, it's not support anymore, is it? It's resistance. Breaks the neckline, and that was it. And then I just was marking them off the levels and where, the areas that they had to watch, and then it would break, and then you held the bar here and tied the retest. So once you see these retests, this is just technical analysis 101, but once you see these retests, gives you a pretty good understanding of what's going to go. I would expect volume besides NVIDIA next week to be light. And this week, you're going to see a lot of people travel. So tomorrow's volume may be light as well. That's it.